Welcome to the Explainer. Today we're doing something a little different. We're getting our hands dirty, cracking open an actual investor's portfolio, and tearing it down piece by piece. We're going to find out what's working, what's hiding, and how to build it back even stronger.
So before we put our example portfolio under the microscope, just think about your own for a second. Do you know, really know, what's in there? What hidden risks or wild concentrations might be lurking just under the surface? Well, let's find out.
All right, first up, the diagnosis. We're putting this thing on the exam table and taking a full-on X-ray of its holdings. We're going to tune out the noise, ignore the hype, and just look at the cold, hard data to see what this portfolio is really made of. And you know, at first glance, this thing looks like a highlight reel from the last couple of years, right? You've got Nvidia, Tesla, Apple, Amazon. It's a who's who of big-name, high-growth tech stocks. It feels exciting, it feels powerful, but is that the whole story?
Well, our first X-ray finds a problem, and it's a big one. A whopping 49%, that's basically half of the entire portfolio, is crammed into one single sector, information technology. Think about it this way. It's like building a house where half the foundation is resting on just one pillar. If that single pillar starts to wobble, the whole house is in trouble.
And that concentration problem doesn't stop with sectors. Nope. Geographically, this portfolio has a massive home country bias. 91% of its holdings are based in the United States. That means it's missing out on growth and diversification from literally the entire rest of the world's economy.
And as we zoom in even closer, you see the problem gets even more specific. This isn't just a bet on tech. It's a few very concentrated bets within tech. You've got a huge pile of chips on semiconductors, another on AI software, and another on EVs. These are all closely related bets that tend to move up and down together.
So what's the bottom line here? All this concentration means the portfolio has what we call a high beta. In plain English, this thing is built for volatility. When the tech market is booming, this portfolio is probably going to boom even higher. But, and this is the part you really have to hear, when the market turns south, the fall is likely to be much, much faster and steeper.
Okay, next section, the environment. A portfolio doesn't exist in a bubble, right? To really understand the risks we're looking at, we have to understand the economic world it's operating in right now.
So the good news first. The overall U.S. economy is looking pretty healthy. We're seeing solid GDP growth at 3.3%. That's a nice tailwind, and it gives the stock market a pretty supportive foundation to build on.
Now let's talk about the number that the Federal Reserve is absolutely obsessed with, inflation. It's cooling off, coming in at 2.9%, and this is a huge deal because it gives the Fed breathing room to maybe hold off on rate hikes or even cut rates, which is usually like rocket fuel for growth stocks.
And the last piece of the economic puzzle is the job market. It's softening up just a little bit, with unemployment at 4.3%. Now that might sound bad, but for economists, this is kind of the Goldilocks scenario. Not too hot, not too cold. It suggests the economy is slowing down gently, not about to slam on the brakes.
So the backdrop looks okay, but there are some serious storm clouds on the horizon. Things like potential tariffs, general uncertainty about what the Fed will do next, and especially for this portfolio, you've got to watch out for real-world constraints like the power grid's ability to handle the AI boom and, of course, the ongoing tech tensions with China.
All right, so we've got the diagnosis, we've surveyed the environment, now it's time for the most important part, the prescription. Let's map out a clear, simple action plan to get this portfolio back in good health.
And that leads us to the big question, doesn't it? It's one thing to point out all the problems, but what do you actually do about it? What's the move here? How can we make this thing more resilient, ready for whatever the market throws at it?
The strategy is a simple 1-2 punch. On one side, we're going to trim some of the areas with the highest risk and concentration. That means some of the semis and more speculative AI plays. Then we take that cash and we buy assets that add some much-needed balance and defense.
So let's break down the buys. 3 simple steps. First, we add ballast with a utility company. It's actually a really clever way to play the AI boom defensively. More AI data centers means way more demand for power. Step 2, we go global with an ETF like VXUS to fix that US-only bias. And third, we add a quality core. SCHD is basically your sleep-at-night fund full of stable, dividend-paying companies.
Now, what about the sell side? Look, the goal here isn't to just dump everything. We're not saying AI and semis are bad investments. Far from it. This is about risk management. It's about right-sizing the positions.
We're going to cap the whole semi-theme at a more reasonable 25 to 30% and shrink that speculative bucket down to something much more manageable.
So, after we make these moves, what does the after picture look like? Let's take a look at the blueprint for a much more balanced, resilient, and robust portfolio for the future.
You can see it right away, can't you? The new target is so much more balanced. Yeah, we still have a strong core in US growth and semis, but look at what we've layered in. A real 10% slice for international stocks, a 5% piece for that dividend value core. This is what a balanced structure actually looks like.
So why does this new plan work so well? It's really the best of both worlds. You get to keep that powerful growth engine from AI and semis, but you put a sensible cap on the risk. You add a defensive play that's actually tied to that very same AI boom. You get exposure to international stocks that might be cheaper, and you add that quality core to act like a shock absorber when the ride gets bumpy.
Ultimately, this new blueprint systematically plugs all the holes we found in that initial X-ray. Remember? Before, it had 0 bonds, almost no defensive stocks, and that massive US focus. Well, the new plan addresses every single one of those gaps.
And that really brings us to the final thought. This entire teardown showed us a portfolio that was perfectly designed to win yesterday's race. So the question you have to ask yourself is this. When you take an honest look under the hood of your own investments, is your portfolio truly built for the future, or is it stuck in the past?